We had Professor Krugman on earlier this week, and he said there was basically zero chance of the Fed getting it right on interest rates. Either they were going to go too early and roil markets, or they were going to move too late and we'd have a strong economy and there'd be
an easy call to make.
Inflation.
Really grasping for the low fruit there.
I'm just wondering if you could chime in on that.
Yeah, I really don't understand Paul's statement there. I actually thought he was very supportive of Janet Yellen and the Fed. You know, I mean, clearly, you know, we don't have a crystal ball and knowing everything that is happening, but to say there's zero chance that they can get it right, I mean, it seems to me to be quite extreme. I mean, I still think the Fed is going to go in September unless the data proves quite weak over the next 2 months. I don't think a quarter-point increase is going to collapse our economy by any sense. In fact, I actually think the best stock gains are actually going to come in the fourth quarter after we get an increase out of the way, which everyone is so very scared of. So,
well, you know, I think Dr. Krugman is saying there's zero chance that she's going to get it exactly right, and I don't think any Fed chair is going to get it exactly right. It's an incredibly difficult job.
If
you were tapped, you were tapped to be a Fed governor and declined back under the Bush administration.
That's right.
But to his point, do you think that she's too late? I mean, are we in a situation right now where we should be at zero, or should we actually be normalizing? Should we have been normalizing already?
No, I'm one of these people. I believe that there are strong fundamental forces driving interest rates down that go way beyond what Janet Yellen does on monetary policy. The effect of the crash 7 years ago is still with us. The desire for liquid assets, the aging of the population, the risk aversion of the average investor, which had gone way up, has not disappeared. We see pension funds de-risking their portfolio, going out of equities into bonds. We have very slow GDP growth. We have very low inflation, which the Fed still hasn't hit its target. I mean, these are all overwhelming reasons why we've had the collapse in interest rates. And so, yeah, I actually think that zero short-term rates and what do we have, 2.5 at the 10-year are really quite appropriate given where the economy stands today. So, no, I don't believe that the Fed is artificially pushing those rates down. And, boy, if they, you know, relaxed, they would pop back up. But, no, we live in a different world, a very different world than we did 10 years ago. And those impacts are still being felt in the market.